LG Chem separated its battery operations and listed a new firm, LG Energy Solution, on the stock exchange, after which LG Chem's share price declined. The move cast fresh light on dual listing. Yet the issue reaches beyond finance, shaped by wider social structures. Here, we explore the realities and consequences of dual listing in greater depth today. Dual listing and the holding company discount. Dual listing refers to splitting off a business that was originally part of a company, creating a new firm, and listing that new company on the stock market. In this situation, both the original company and the newly created company remain listed, and the company's value ends up being evaluated separately. When an important business is spun off, the market may no longer view the original company as an operating company, but rather as an investment company that owns other firms. As a result, the company's value may be assessed lower than its actual worth. This phenomenon is called the holding company discount. Separated value, marginalized shareholders. Dual listing continues to occur because it can be beneficial for companies. By separating a business and listing it independently, firms can attract funding more easily from external investors while still managing the new company and supporting its growth. In simple terms, it offers an efficient way to pursue expansion without requiring large amounts of their own capital upfront. However, a key issue is that the original company often holds shares in the new company, while existing shareholders do not directly receive those shares. As a result, investors may feel, "The company I invested in was split. Why don't I get a stake in the new one?" Limits of minority shareholder protection. Dual listing is regarded as particularly problematic in Korea because of the corporate structures involved. Large conglomerates typically consist of a parent company overseeing numerous subsidiaries. In these arrangements, even after a spin-off and listing, the original company continues to control and manage the new entity while also using it as a means of raising additional funds. This can lead to more dual listings, concentration of capital in certain corporate groups, and issues of unequal investment opportunities and fairness. In many countries, when firms are split, existing shareholders are often granted shares in the new company. In Korea, by contrast, protections are weaker, leaving shareholders potentially disadvantaged. The issue reflects corporate governance structures, the distribution of profits, and levels of investor protection. It also signals the need for broader public debate around these deeper structural problems today.